Everybody, welcome to the morning market briefing, June 6, 2022. Futures up quite nicely. Dow futures up 80 basis points. S&P futures up about 1%. NASDAQ futures up about 1.5%. We got oil up, we got silver up, we got gold up. Everything's green right now. Let's hope that holds for the rest of our careers. That'd be awesome. Walmart talking about an inventory glut. Ben, we got problems.
Yeah, we've heard this from a number of people. Basically, they have the wrong inventory. And the Walmart chief of U.S. operations, John Furner, on Friday at the annual meeting said, quote, "It's probably another couple quarters until we manage the inventory down to where we want it." Separately, Doug McMillon, he was pressed on what Jamie Dimon had said about a hurricane coming, and he said he is concerned about the harm to U.S. households from high inflation rates, particularly if price increases remain elevated for months to come. So what they're doing is, and this is kind of an odd tack that he took, because he talked about things very broadly, and then he said, in order to soften the impact on households and compete with dollar stores, he plans to, quote, limit price hikes on basic goods such as canned tuna and mac and cheese. So I thought it was just kind of really interesting that he called those out. So if you want to get a deal, I guess go get canned tuna and mac and cheese from your local Walmart. But basically, big takeaway is Walmart is seeing at least a mix shift in the consumer, a consumer that's more focused on making sure that they're making the value conscious consumption choice rather than just buying whatever they want at that moment.
Here's a pro tip: mix them together. It's the poor man's lobster mac and cheese.
It's gonna be a hard pass. I don't know. Maybe if things get tight. If things get tight, we might have to take that path. Yeah, it's interesting. I mean, I think, and we're seeing kind of in a little bit of a tangent, I guess, but in a similar fashion, Amazon making some changes. It seems like companies are having to really react and at times possibly even overreact to just a quickly changing economic picture. We see that with Amazon. Their head of worldwide consumer business is leaving. Ben, how do you kind of digest that, and what do you think they're trying to process?
It's a bit of a surprise. The guy's only 49 years old. You'd think he has a pretty good business, basically being part of what will almost certainly be the largest retailer in the world by the time he retires, and he's leaving at age 49. He's been there since the beginning. Obviously, Andy Jassy taking over for Jeff Bezos a year ago heralded a little bit of a shift in terms of leadership. Maybe Dave Clark felt a little bit snubbed by that. Nevertheless, I think this is a pretty significant time for him to leave. It probably also reflects the impact of lower stock-based compensation. If you're getting paid a large portion of your income in stock, and now the stock is down 30-40% from where it was, you have a lot less incentive to continue to work, because it's going to take a really long time to get back to that high water mark. And so what's the point from Clark's perspective? And he says, Andy Jassy actually did comment on this departure, saying the past few years have been among the most challenging and unpredictable we faced in the history of Amazon's consumer business. Particularly appreciative of Dave's leadership during that time. Still have more work in front of us to get where we ultimately want to be in our consumer business. And so they don't even have any plans for Dave's succession at the moment. They'll have an update in the next few weeks. Amazon, of course, in a similar position to Walmart, Amazon is trying to shed a lot of the capacity that they took on during the pandemic. They bought a lot of warehouses. They're trying to get rid of those warehouses now because they have too many. And so I think Amazon's consumer business is in a little bit of a tough shape right now. That's not a surprise. They still have their strong Amazon Web Services franchise. And as for the stock, it's already down 30-40% from where it was. And the stock splits 20-1 today. So instead of being a $2,200 stock, all of a sudden it'll be a $105 stock or so.
Yeah.
So it becomes a lot more accessible for a lot more accounts.
So Amazon's gonna be down 95%.
Yeah, don't panic if you see that in your account. It's already showing in there like that. It caught me off guard this morning as well, even though I was prepared for it. So everybody chill.
Everybody relax. I am glad to see that it's actually working. We have had instances in the past where there's a split and the price goes down and the share count doesn't change for a day or two, and people really wonder what happened, where'd my money go? So yeah, don't panic. But yeah, it's an odd spot. I mean, we were talking with a client that has pretty decent exposure to all kinds of commercial and industrial real estate and development last week, and one of the things they mentioned to me were just their relief that they've really shifted away from just raw warehousing. They said, a couple of years ago, that was a much larger portion of their business. They were building for the likes of Amazon. I don't know if specifically for Amazon, but they've certainly seen the trends change there, kind of on the day-to-day demand side of what people are looking to have built. We did get ISM services data on Friday. That seems like forever ago, but it came in after the morning call. Headline number came in at 55.9. The expectation was for 56.5. Previous reading was 57.1. Price is down a little bit, but not necessarily a huge move there, Ben.
Yeah, I think that we're not seeing the rapid decline in inflation that we thought we were hoping we would, at least what was in the narrative the week of Memorial Day, when the market rallied pretty strongly. I think that we're still seeing some supply chain issues. We will get a CPI reading on Friday. Right now, the estimate for that is 8.3%. Last month was 8.3%. So the core reading is expected to come down just a little bit, but food and energy really starting to really crimp consumer budgets. We'll talk a little bit more about that here in a second. But today's an inflationary day. We're seeing stocks up, bonds down, interest rates up. That's what happens as you see more inflation.
Meanwhile, we do have Elon Musk. We can't go a week without talking about him. Sent out an email essentially to everybody at Tesla saying they will reduce salaried headcount by 10%. This will not apply to anyone actually building cars, battery packs, or installing solar. Hourly headcount will increase. We've seen a number of hiring freezes, some layoffs trickling through. He maintains that their workforce is actually going to grow, but they're overstaffed in some areas. A wild email. We'll just say that I liked the not so subtle. This does not apply to people that are actually doing what we're doing. So who's getting cut there?
I think it's the middle managers, and
Yeah.
I think that's the area that has been bloated. These are the people who, frankly, and I was talking with my old boss on Friday about this. I think there is a lot of bloat within the middle section of corporate America right now. A lot of these people get paid a lot. They've increasingly been working from home, and that job, the more you work from home, the more that job becomes a commodity, because that means anyone can do it. You don't have to show up in the office. So I think that's a place that's being cut, and Elon Musk is kind of leading the way on that.
I think that's just good management. At the end of the day, they make money building cars. So if you're actually physically building the cars, you're not a cost center. You're pushing profits. If you're in an office somewhere or working at home, pushing emails around, odds are you should be on the chopping block if you really want to stay lean in a company.
Yeah, it makes sense. And I think we're going to continue to see that trend. I think that middle management area, the excess analysts, people like that are probably the folks most likely to be in the crosshairs. Ben, set us up for the week ahead. What are we looking at?
Yeah, so I thought today and tomorrow was going to be fairly quiet, but now we have a no confidence vote occurring in the UK for Boris Johnson, which is kind of wild because he just crushed it in the last elections a couple of years ago. But in the meantime, everything that's come out in terms of the Partygate, where he had a social gathering, which he wasn't supposed to have in May of 2020. And then on top of that, you just have the economy. And ultimately, I think that's what it comes down to. I think that there are a lot of issues that could be distracting for voters in the interim, but by and large, it comes down to the economy and how consumers feel about that. And when consumers do not feel good, and when the people do not feel good, it's not good for the leader. And I think that's what we're seeing. Inflation is high in the UK, like it is in the US. And the economy is closer to recession even in the UK than it is in the US. So things are not great over there. Now, a no confidence vote, I actually don't think that it'll pass among the conservatives in parliament, but I do think it just goes to show Boris Johnson's decline in popularity. And the Conservatives don't have someone who would be an obvious choice to replace him at this moment. I think they would find someone, but right now, my guess would be there will be a no confidence vote, but Boris Johnson will escape and will remain prime minister. Beyond that, later this week, we have a 10-year note auction on Wednesday. We have a 30-year bond auction on Thursday, and then we have the all-important CPI number on Friday. And again, if that starts to come down, I mean, if we get a 7 handle on that on Friday, that's really good news, and I think the market will rally strongly. But if we actually print 8.3%, or actually even above that, it could be tough for the market.
Yeah, that sets us up for next week's Fed meeting. Tom, you looking ahead to that, isn't he?
Yeah, I think there's nothing really to report there. I think that unless something goes really haywire with that CPI number, we're probably going to continue to step up at 2 rate hikes per meeting. There's really not been a lot of pushback on that from anyone. So the Fed seems to be relatively aligned for the first time, at least this year, I think, at least heading into a meeting. So, I mean, the big ones, yeah, the auctions this week are going to be telling. We've seen the 10-year and the 30-year tick up pretty slowly over the last couple of weeks, much more slowly than they did when they peaked out a month ago. And the slow movement, I think, is beneficial as well. But the fact also that the CPI number comes out after the 30-year bond auction is going to be helpful for those trying to buy it, and will probably push demand because you're, basically in a position where you don't have a wild piece of information coming out prior to the auction. So they should go off relatively organically. That being said, if you buy a 30-year treasury and then we get a 9% print on inflation, you're going to be in the danger zone. So it'd be interesting to see how the breakdown is versus who bought, who didn't, where the money came flowing from. And we'll get into all of that on Friday morning before the CPI comes out.
Good deal. We're going to wrap it up there. We'll be back tomorrow morning at 8:30. Hope you guys have a great day. One thing I will tease out, we're starting a new market memo that will come out. It'll be a little bit like these calls in terms of content, but look for that in your email inbox Friday afternoon. We're going to start that this week. It'll come out, kind of capture some of the biggest stories of the week. Quick commentary, should be a quick read. The goal is keep it at about 1 page with quick hitting data. So Ben's kind of taking the lead on that. Look forward to sending those out. And if you have questions on that stuff, never hesitate to reach out.